Guys, something crazy just happened in the market right now towards the closing moments. The spread between the 10-year and the 2-year treasury note is now at 0.11, dangerously low levels. We've talked about this before. I'll get into it in the video some more. But if this gets to below zero, then we are likely in for a recession. When the spread between the 10-year treasury note and the 2-year treasury note has inverted, meaning when this drops below zero, that has preceded a recession each and every single time going back to 1956. We're talking about 66 years worth of data here. This also comes at a time when the markets are absolutely blasting off into oblivion. We have this W-shaped correction. Markets are up 11% in just a little over 2 weeks. These are gains you usually expect to see for the whole year and not for just a 2-week period. However, this looks eerily similar to 2018, and with the possibility of this yield curve inversion, things are starting to look a little shaky. However, I'm on record as saying that I believe we will still likely get back to all-time highs this year. I don't know if we will make new highs, but we will likely get back to all-time highs and peak this year, even if that progress or that route looks shaky. Now, in terms of what you should do with your portfolios, obviously, it's up to you. Talk to a financial manager. In my case, and in my view, this right here is a no buy zone. This is not a buy zone. I've talked about ad nauseum why previous levels were buy zones, especially at the 300-day moving average, or breaking out of this wedge, or finding support at the bottom of this W channel here. To me, those were all good buy zones because the price was too advantageous to pass up. On the SPY, on the Qs, you were getting over a 40% discount on Tesla. You were getting 25% discounts on Microsoft and Apple. The healthcare sector of the S&P 500 was at major support. The consumer staples section of the S&P 500 XLP was at major support. XLE is now ripping into all-time highs as the energy sector is sort of seeing the benefit from the shortage of oil due to the geopolitical issues that are obviously going on in Europe at the moment. These, by the way, along with others, were all buys that we bought on the dip and alerted in the private trading group. Come be a part of it if you wish. Those, along with stocks like Nvidia, Google, etc., all of the buys that we thought were worth buying at those price points were called out. At the moment, our hedges are taking a hit because obviously the market is ripping, but we continue to maintain hedges really going back to November. However, those hedges now are significantly down, but in comparison to our portfolio, those are smaller positions. But here's why the markets can likely get back to all-time highs if we cross this pivotal level here that you see. This is called the golden pocket. Now, for those of you that aren't familiar with TA, I won't spend too much time on this, but just know that around 455 is where the SPY needs to get above in order to cross the hump and potentially get back to all-time highs. Also, keep in mind, this is coming on the heels of April. April being the second best month in terms of average return in the S&P 500 ever, going back to 1950. April is an extremely strong month for stocks. This in part is because it coincides with mid-season earnings. April is when all of the major companies, the mega cap companies, report earnings again. Also, keep in mind that since that 1955 date, where I said that if we have a yield curve inversion, and I will describe what that is in a second if you guys are interested, but when we have a yield curve inversion, that the market actually peaks usually after that yield curve inversion, and a recession doesn't happen until at least 7 to 24 months. So just because this yield curve inverts here does not mean that we are going to tank straight away. Now, it could be volatile if the yield curve actually inverts, is going to cause a shock to the market, but then we will likely see another rally in the market if there is nowhere else to put your money. That is part of the reason why I did that video saying that is this breakout rally, is this actually a real breakout? And the fact that and why it was actually breaking out was due to the fact that there is nowhere to put your money. This is called TINA. There is no alternative, right? Real estate is too expensive and scarce at the moment. Bonds, nobody's buying. You could see the 2-year auction here. The 2-year auction went by unnoticed, and you saw the 2-year bond just skyrocket from what it was previously at 1.55% to now 2.36%. That is because nobody bought the 2-year notes. So now comes a time where I will discuss what are the bond yields and bond yield curve inversion. This is not going to be boring. I promise, so stick with me. See, you have the 2-year bond and the 10-year bond, right? If I told you, hey, Which one of these is going to pay more if you put your money into it? This one, you have to keep your money in here for 2 years. This one, you have to keep your money in here for 10 years. Well, you would expect this one to pay way more than this one because you have to hold your money for 5 times the length of time, right? So let's just say hypothetically that the 10-year pays you 2.5% and the 2-year pays you 1.5%, right? Well, in a yield curve inversion, this happens when the 2-year actually pays more in yield than the 10-year. How could that be, you say? Well, if folks are terrified about short-term inflation, they're not going to buy these 2-year notes. They are likely going to stick to longer-term notes like the 10-year. And with bonds, the more that people pour into bonds, this drops, the yield drops, right? Just know that that is a thing. I'm not going to explain exactly why that is here, but just know that the more demand there is for a bond, the yield will drop. And the less demand there is for a bond, the yield will go up. So nobody's buying the 2-year. Everyone is buying up the 10-year because they want to secure their money for a much longer time. And everyone's scared of the short-term effects of inflation. So eventually the 2-year rate starts going up past the 10-year. And that is how we get this deal spread here. So right now, or sorry, not deal spread, but yield spread. So the spread between the 10-year and 2 years just 0.11, meaning if you subtract the rate of the 10-year minus the rate of the 2-year, we're at 0.11. And if this goes negative, it means that the 2-year is now higher than the 10-year. And every single time this has gone negative, we've dipped into a recession within 7 to 24 months. So when I hear comments like, oh, are we bearish or are we bullish? Time frame matters. If this yield curve inverts, then in the midterm, meaning within 7 to 24 months, we could see a recession. And if we don't, that'll be the first time ever since after World War II that has happened. But in the short term, does that mean that we can't get back to all-time highs? No. If we break above this golden pocket level on the SPY, above 455, 456, and close above that, we will likely get back to all-time highs because there's nowhere else to put your money. And stocks right now are seen as a hedge against inflation. You're not going to get a hedge against inflation in bonds. You're not going to get it in real estate. You're not going to get it in gold. You're not going to get it anywhere. But the stock market, if it is actually able to generate returns, still crazy returns like 11% in an index in 2 weeks, then yes, that is likely going to be seen as from a larger pool of investor standpoint as a hedge against 8% inflation. And this is a short-term outlook. So in the short term, you could be bullish. In the long term, you could be bearish. Whether you're bullish or bearish really is irrelevant if you're not describing the time frame that you are talking about. And lastly, this reminds me a lot of what happened in 2018, the last time that we had significant Fed monetary policy. For those who weren't around in the market in 2018, we had a very similar pattern. We had that W correction, right? We had this drop and then the W correction, just like we see now. I'm talking about this period here, right? And we had this W correction, as you can see here, very similar to what we see now. And it looked like things were rosy and we were going back to all-time highs. But look at where we actually stopped. Look at the exact point at which this rally stopped. This rally stopped right at the golden pocket. Now, again, I'm not going to describe exactly what this is, but it's a Fibonacci level. If you go to where we are now, we have a W correction in 2022 on the S&P 500, and we are right at the golden pocket going into another round of unknown monetary policy. And for those that want to know what the monetary policy event was back here, this is where Janet Yellen was basically raising rates. And in 2018, we got 3 rate hikes. And Jerome Powell was expected to continue that in 2019 and said that we would get another 2 to 3 rate hikes. Now, the market didn't like that because there were signs of a slowing down economy in 2018. And guess where the yield curve was at the end of 2018? Same place it is now at around 0.10, 0.11. Same exact place it is at now. The market didn't like the possibility of more rate hikes into a slowing down economy, and we started tanking. And that is when Jerome Powell took his foot off the gas and Trump basically said that he was dangerous, right? And then Jerome Powell caved and said, okay. No rate hike in 2019. What did the market do? Because it loved this accommodative policy, it started rallying back up again, baby. So if we don't get across that golden pocket level, it would not surprise me if we saw something very similar to 2019, it doesn't have to happen exactly the same way, but we are basically hiking rates into a slowdown economy because our hands are tied and the Fed has no other tools left to combat inflation. So again, whether you're bearish or bullish really depends on time frame. In the short term, if we get above this golden pocket, we could see all-time highs again because there's simply nowhere else to put your money. If this yield curve inverts, then we will likely see a recession in the midterm. But either way, in my view, stay the course. That is the plan, especially because you see how these things play out. You miss the best days in the market. Before you know it, you're back to all-time highs and you're making a historic run once again. So when stocks that you really want to own are too cheap to pass up, you buy that shit. Don't be the person that doesn't line up for a blue chip stock sale. But at the end of the day, it's up to you. You're going to do what thou wilt. If you want access to all of our trades, stock purchases, etc., link is in the description below. Come be a part of a group of thousands of traders. Would love to have you. Leave a comment down below. Let me know what you think about this. Are we in for a recession? Are you bullish on stocks? Are you in all cash? I love to hear from you. I try to respond to every comment. Leave it down below. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.